Are you looking to find the best ETFs to invest in right now at the approach of 2024? Well, today you'll find the 3 best Canadian ETFs that you can buy right now and hold in your TFSA or in your RRSP for 2024. Without further ado, let's take a look at my pick number 1. Number 1 on my list is the Vanguard S&P 500 ETF with the ticker VFV. How could I make a list of the best Canadian ETFs without mentioning this fan's favorite? Indeed, this ETF is quite popular among the investors in Canada because it is tracking the famous S&P 500 index, which is an American index composed of the 500 largest American companies in terms of valuation. It is why you can find a large portion of the total assets of this fund in the 2 largest companies in the world, which are Apple and Microsoft, and in fact both of them worth about 7% of the total assets of this fund. And among the other big holdings of this fund, you can find other great popular companies such as Amazon, Nvidia, Alphabet, and Meta. And so with no surprise, the technology sector comes as the largest sector of this fund with about 27% of the total assets of it. And after you can find the healthcare, the financials, and the consumer discretionary sectors. Since the American market is by far the largest and the most popular stock market in the entire world, it makes that by investing in this ETF, you make sure to have a great screening of the overall economy in the world. And historically, over the last couple of years and decades, this type of fund has always been the great winner when it comes to the total return, because in fact 10 years ago, if you would have invested about $10,000 in that fund, this would now be worth over $51,000 or an annual average return of about 14% during that period. And the beauty of it is that by having a passively managed approach, this type of fund will only cost you about 0.09% per year of annual fees, which equals to about $9 per $10,000 invest. And according to Morningstar, with the same level of risk, this fund has been able to outperform the same fund of its category over the last couple of years. Add with an interesting quarterly dividend distribution of about 1.16%, this is definitely one of the best ETFs that you can currently find on the Canadian market. Now that you've found what is the best Canadian ETF to track the overall American market, it is a time for you to find what is the best Canadian ETF tracking the overall Canadian market. And so it is why I've decided to include the iShare S&P TSX Cap Composite Index ETF with the ticker XIC. On its side, this fund is simply tracking the entire Canadian market. And so it is the best solution for you if you don't want to have the trouble to pick different ETFs that will target certain portions of the Canadian market. And when we know that the Canadian market is way more defensive compared to the American market and at the same time is giving some better dividend payments, it makes that these 2 ETFs are great complementary options if you want to have a great diversified portfolio. And among the largest holdings of XIC, you can find the big Canadian banks such as TD and RBC, but you can also find other great companies such as Shopify and Enbridge. And so with no surprise, you can find that the financial sector comes as the largest sector by far, and after you find the energy and the industrial sectors. Over the last 10 years, by investing $10,000 in that fund, this will now be worth over $22,000 or an average annual return of about 6.5% per year. And so despite representing about half of the total return of VFV over the same period, well, we can find that over the last 3 years, the performance of both of these ETFs is quite similar. This type of outperformance of VFV over the long term comes from the fact that, as I told you earlier, the American market tends to be more volatile than the Canadian market. And it means that when the global economy will do well, it means that the American market will tend to outperform the Canadian market. But when the global economy will slow down and comes at a recession, it means that the Canadian market will tend to be safer compared to the American market. And so it means that it will tend to lose less value compared to the American market. And in my opinion, why XIC is the best option compared to one of its big competitors in Canada, which is XIU, is the fact that it has some super low management fees of about 0.06% per year or $6 per $10,000 invest. All of this while Morningstar is rating this ETF as being in the average when it comes to the potential of return and the total level of risk of this fund compared to the average average of its category. And the big advantage of this type of ETF compared to the first one that I've just presented to you is the fact that it is giving a higher quarterly dividend distribution rate of about 3.39% per year. And finally, if you're looking to add even more geographical diversification and find what is the best international ETFs proposed in the Canadian market, well, the answer to this question would be the Vanguard FTSE All Cap Except North America Index ETF with the ticker VIU. This fund seeks to track the performance of all size companies proposed on the different developed markets except in Canada and in the US. It is why among the 3,800 holdings that they have, you can find great quality companies such as Novo Nordisk, Nestle, ASML, Samsung, and Shell among its biggest holdings. And the vast majority of the companies found within this ETF comes either from Europe or the Pacific, with countries such as Japan, the United Kingdom, and France coming as the largest countries represented in this fund. And when it comes to the sectoral distribution of this fund, we can find great diversity among the largest sectors of it, where we find that the industrials, the financials, the consumer discretionary, and the healthcare all comes as the largest sectors of this ETF. Since the inception of this fund on the stock market in 2015, if you would have invested about $10,000 in it, it would now be worth over $15,000 right now, or an average annual return of about 4.50% per year. And by investing in that fund, you can expect to pay some slightly higher management fees of about 0.23% or $23 per $10,000 invest. These higher fees come from the fact that the fund manager of these type of funds will need to manage and to analyze way more companies compared to the two other picks that I've just presented to you. And on their side, Morningstar is also giving them an average rating compared to the same funds of its category when it comes to the total potential of return and the total level of risk of it. Plus, this ETF is also giving great quarterly dividend distribution of about 2% per year. So obviously, even if this type of ETF has been underperforming the two other funds on my list, the big advantage of it is that it will give you way more geographical diversification in your portfolio, which will obviously reduce your total risk. Obviously, there are other great options instead of these three ETFs that will, for example, track the overall market with an ETF such as VEQT, or a more niche ETF that will, for example, track the corporate bonds market with an ETF such as ZAG. However, in my opinion, these three ETFs are a perfect base for any Canadian investor that is a beginner, especially if you want to have access to the most important markets in the world at a cheap price and most importantly with a low level of risk. But on your side, if you're looking for another Canadian ETF that is giving over 5.30% of monthly income distribution to their shareholders with no risk, well, check out the video that's gonna be right over here and I will see you soon. Peace!